September 18, 2017. Toys R Us, the company that defined childhood for 3 generations of Americans, files for bankruptcy. Within 6 months, 800 stores go dark. 33,000 people lose their jobs. And the founder, 94-year-old Charles Lazarus, dies one day before the liquidation sales begin. The media blamed Amazon. The internet killed the toy store, they said. But that is not what happened. When you follow the money, the real story is far more disturbing. Toys R Us was not killed by competition. It was killed by the people who bought it. And to understand how, you need to see what they destroyed. Because this was not some struggling discount shop. The year it filed for bankruptcy, Toys R Us still accounted for 1 out of every 5 toys sold in America. Think about that. 20% of the entire United States toy market, and the company was being sent to the graveyard. No business should go bankrupt with that kind of market share, unless someone is draining it from the inside. Let us go back to the beginning. In 1948, Charles Lazarus, a 25-year-old World War II veteran, starts selling baby furniture from his father's bike shop in Washington, D.C. He notices parents keep asking for toys. By 1957, Lazarus opens the first Toys R Us in Rockville, Maryland, a warehouse-style supermarket for toys. Nothing like it had ever existed. He stacked merchandise high on shelves, supermarket style, giving shoppers the feeling the store had an infinite number of toys. And kids lost their minds. By 1978, the company went public with 72 stores and controlled 5% of the entire American toy market. By the mid-1980s, Goldman Sachs called it one of the outstanding companies in all of retailing. By 1990, the empire had grown to over 1,500 stores worldwide and $11.2 billion in annual revenue. Geoffrey the Giraffe was as recognizable as Tony the Tiger. The "I don't want to grow up" jingle was stuck in every American child's head. Charles Lazarus was earning over $60 million a year, making him one of the highest-paid executives in the country. But here is where the cracks begin to show. And the first crack has nothing to do with Wall Street. In 1998, Walmart surpasses Toys R Us as America's largest toy seller. Walmart uses toys as loss leaders, selling them below cost, just to get families through the door. Toys R Us, which only sells toys, cannot compete on price. Then comes a decision that would prove catastrophic. In 2000, instead of building its own online platform, Toys R Us signs a 10-year exclusive deal with Amazon, paying $50 million a year plus a percentage of sales to be Amazon's exclusive toy seller. Customers who visit toysrus.com are redirected straight to Amazon. For 6 critical years, Toys R Us built 0 online capabilities. Let that sink in. They handed their entire digital future to a competitor and paid them to take it. By 2003, Amazon starts allowing other toy sellers onto its platform, violating the exclusivity deal. Toys R Us sues and eventually wins $51 million in 2009. But the real damage is already done. Amazon has learned the toy business inside out, built its own logistics, and captured Toys R Us's customer data. 6 wasted years. These are the exact years Amazon evolved from a scrappy startup to an online overlord. And that mistake left Toys R Us weaker than ever, which is exactly when Wall Street moved in. March 17, 2005, a consortium of 3 firms, private equity giants KKR and Bain Capital, and real estate firm Vornado Realty Trust, announces a $6.6 billion leveraged buyout of Toys R Us. The theory is simple. Take the company private, fix it, and sell it back to public markets at a profit. But here is the part they do not tell you. The 3 firms put up only $1.3 billion of their own money. The remaining $5.3 billion is borrowed, and the company being bought, Toys R Us, is made responsible for paying back all of that debt. Think about what that means. Wall Street firms buy a toy store using the toy store's own future earnings as collateral. Before the ink is dry, Chief Executive Officer John Eyler receives $65.3 million in compensation when the deal closes. The executives are bought off, the debt is locked in, And from this moment, Toys R Us is no longer a toy company, it is a debt instrument. And here is where it gets truly devastating. With $5 billion in debt on its books, Toys R Us is spending $400 million every single year just on interest payments. That is not a typo, $400 million every year. That is more than the company spends on its stores and its website combined. Every dollar that could have gone into better stores, stronger e-commerce, or competing with Amazon goes instead to servicing debt that the company never chose to take on. Meanwhile, KKR, Bain, and Vornado collect $15 million per year in advisory fees, increasing 5% annually. According to filings analyzed by the Private Equity Stakeholder Project, the three firms extract a total of $470 million in fees and interest from Toys R Us over the course of their ownership. If you have ever wondered why a store with 1/5 of the American toy market could not invest in a better website, this is why. The money was going to Park Avenue, not to the shelves. The firms try to cash in. Between 2010 and 2013, they attempt to take the company public. But the IPO is withdrawn because sales are declining. Vornado quietly writes down its investment to zero, meaning they consider their own shares worthless. The cash reserves that once stood at $2.2 billion shrink to just $301 million. And still, the debt payments keep flowing. As economist Eileen Applebaum of the Center for Economic and Policy Research put it, this was not a case of a company that did not know it needed to do e-commerce. It simply had no resources. The death spiral begins in September 2017. Toys R Us files for Chapter 11 with $5 billion in long-term debt and borrows another $2 billion just to keep stores open through the holiday season. But holiday sales disappoint. Suppliers, spooked by the bankruptcy filing, start demanding cash up front for inventory. Without stock on the shelves, the company cannot meet demand. On March 15, 2018, the bankruptcy court approves full liquidation. 800 American stores begin closing. 33,000 workers lose their jobs. No severance. Toy industry executive Isaac Larian of MGA Entertainment tries to raise $200 million to save 400 stores. The effort fails. By June 29, 2018, every single Toys R Us store in the United States is permanently closed. A company once valued at over $12 billion is sold for spare parts. And then comes the detail that should make your blood boil. On March 22, 2018, one day before the liquidation sales began, Charles Lazarus died of respiratory failure at Mount Sinai Hospital in New York City. He was 94 years old. The man who built a toy empire from a bike shop did not live to see it dismantled. Meanwhile, KKR, Bain Capital, and Vornado walked away after collecting $470 million in fees. Employees asked the three firms to contribute to a severance fund. More than a month passed with no response. Eventually, under enormous public pressure and congressional scrutiny, Bain and KKR created a $20 million fund for displaced workers. $20 million, split among 33,000 people. That is roughly $600 per employee. The firms that had extracted hundreds of millions gave back pennies. Everyone blamed Amazon. Everyone blamed the internet. But the documents tell a different story. Toys R Us was profitable without the buyout debt. It still controlled 20% of the American toy market. As the American Prospect reported, take away the leveraged buyout debt, and the company had growing operating income in its final 3 years. It was not Amazon that killed Toys R Us. It was a $6.6 billion deal signed in a boardroom, financed with borrowed money, and paid for by the company itself. And Toys R Us is not an isolated case. Payless Shoes, The Limited, Wet Seal, Jim Bory, and Sports Authority were all killed by the same leveraged buyout playbook. According to research cited by the American Prospect, 40% of retail bankruptcies between 2015 and 2017 were private equity-owned chains. The pattern is always the same. Load the company with debt, extract fees, and when it collapses, the workers pay the price while the firms walk away with their profits. Charles Lazarus built something magical. Wall Street turned it into a debt instrument and bled it dry. If you want to see how another corporate giant got destroyed by the people who were supposed to save it, check out the next video. Subscribe so you do not miss it. The market never forgets.